Welcome, everyone. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to come back and talk to you again this Thursday. Got a lot to go over. We've seen a lot of change, a lot of character change in the market take place, and so I want to spend some time going over some of those changes. I'm going to jump right in and take a look at the Dow Jones Industrial Average. This is a long-term weekly chart. Because I do these shows weekly, I think sometimes it's helpful to take a look at a weekly chart to see what's transpired since the last video. But you can see prices on the Dow Jones continue to move up, but the weekly PPO continues to move lower. So we have a negative divergence. I've annotated a couple of key support levels where I think over the next couple days, maybe a couple weeks, maybe even a couple months, where we could see prices gravitate back down to. I think we got to be careful here in the balance of the third quarter. What we've seen here over the last week to 10 days, maybe even since the beginning of July in terms of some of the rotation, we could see that continue for a while. But right now, the Dow, continue to watch the key levels that I'm showing here. I think potentially on a drop, we could see as low as 37 to 38,000 on the Dow. Moving on, S&P 500. Also printing higher highs, and you can see the lower PPO. Negative divergence. Some of these divergences, if prices do continue to go up, they can be eliminated. But for now, I think we have to respect that reversing candle that we saw 2 weeks ago or a week and a half ago. And as we continue to move lower, the rising 20-day moving average is going to be our first area of support. And then I've given you a couple of price levels that down the road, if the weakness were to continue, where we might be looking for a big reversal. And I think that could be somewhere down in the 4,800 to 5,000 area if things start to accelerate to the downside. Nasdaq 100, you can see that this divergence, weekly negative divergence, has been going on a little bit longer. We continue to put in higher highs. Currently, we are testing the rising 20-week moving average on the NDX, and that's going to be an important level to hold. If you go back and you take a look all the way back in 2020 and 2021, when we had a nice extended uptrend, look at all the tests of the 20-day moving average that held as we continued to rally. In this move to the upside, say since late October of 2023, we had one quick violation of the 20-week moving average, but we came right back up the next week and held it. And here we are again now, moving back down to test that rising 20-week moving average. This, if you're looking for a possible reversal short term, this would be an area that we certainly could see it, no doubt. On a daily chart on the NDX, you can see that we're trying, and this is just midday, so we'll have to see how we finish this afternoon. But it does look like we've got a long tail to the downside, trying to reverse at a key area of short-term support. This was kind of where we broke out back in the second week of June, clearing that 19,000 level. Now today we're opening and potentially closing above that 19,000 level with a bunch of intraday selling that took place beneath this level. So this could be a short-term area of support. Also check out that PPO, which is right down near the center line, and the RSI, weekly RSI, just below 40. A lot of times 40 provides support. So here's some clear areas to at least be thinking about. Now, a week ago, actually over the last couple of weeks, I've been talking about a market top. I believed the market was going to top. I talked to our EarningsBeats members. I expressed my concern and said, hey, it's time to, take some precaution, whether that's protective puts, whether it's covered calls, whether it's moving to cash, whether it's smaller positions, whether it's maybe moving from individual stocks to ETFs, whatever is appropriate for each individual. I thought it, would behoove us to get a little bit more cautious here over the past week, 2 weeks. And that certainly has paid off. The equity only put call ratio, if you recall, a week ago, the 5-day moving average hit 0.54. And this is just going back the last 3 years and putting this thick horizontal red line across here at 0.54 so that you can see the history of when we hit this level or when we go below it. And what this means is that over an extended period of time, there's a very heavy number of calls being traded relative to puts. So it's telling me that the retail trader is getting excessively bullish, and many times that leads us to a top. And if you see these vertical red dotted lines, they're kind of marking these, 0.54 areas or below and showing you exactly where the S&P 500 was. And on many of these, you can see that it marked the top really, really strongly. And this latest one was perfect. I mean, we've had 2 readings, 5-day readings come in at about 0.54, and check out literally when we topped, right at the right when the marker hit that 0.54 level. The VIX are looking at the S&P 500 and the correlation between the two. Normally, if you see the market go down like we did back in the beginning of 2022, when we go into the extended downtrends, you can see the VIX goes up. Then when we bounce, the VIX goes down. And then when we go back down again, the VIX goes up. It's always this inverse correlation. And if you look at the correlation, which is in the middle panel, you can see that inverse correlation does stay pretty close to that -1 level most of the time. Now, occasionally, we'll turn positive, meaning that the stock market's going down and fear is going down at the same time. That's unusual. Or the market is going up and fear is going up, which is unusual. So when you get these positive correlation readings, and again, I've put this thick horizontal red line in here to mark positive 0.25. Anytime it goes positive, it would get my attention. But if you look at the 3 times in the last 3 years that we have hit 0.25, you can see there was an immediate reversal in the market. Back in 2021, we had the VIX starting to go up in November, and we also had S&P 500 going up. So the market was basically telling me that it was getting more fearful. It was not going to handle any kind of bad news very well. And it was just a short-term indicator. And of course, there was the downtrend. Same thing back at the beginning of 2023. We had, in this case, we had market going down and we had the VIX coming down. So the market's selling off and yet fear is getting lower, telling us that the market really isn't scared of too much. And what happened? We had a reversal back to the upside. And then most recently, you can see that we had the VIX starting to turn back up again while prices were going up. So again, fear is building when the market's going higher. Little strange. So what happened? Came right back down. Market was not prepared for bad news. And of course, we got that last Friday with CrowdStrike and the IT outage. Not to mention some other things like Google's earnings and Tesla's earnings and some other earnings that have been out. But overall, many of the Mag 7 stocks not doing well. Technology in general not doing well. And as a result, we've seen that market, the overall market, the benchmarks rolling over and trading lower of late. Let's keep moving. So we got technology. I wanted to show you the various sectors. So technology's been leading this market to the upside, and it's 32% of the S&P 500. But as we went up, we had a negative divergence on this weekly chart, and we started rolling over. Bearish engulfing candle. The good news is that in the short term, we are trying to hold on to that rising 20-week moving average. We'll see if it sticks. Next up, consumer discretionary, another really aggressive part of the market. Here we made a breakout, which was nice. Unfortunately, we have seen some selling. We've pulled back, and we're testing that rising 20-week moving average. We'll see if it holds. Then we've got the communication services group, which you can see has been in a channel to the upside for quite some time. We had recent highs with a higher highs with a lower PPO. So we've got another negative divergence here coming down. We're testing that 20-week moving average. And if you look at most of these charts, the weekly charts, when you're in secular bull market advances, many times selling is contained at that 20-week moving average. Couple of candles that we failed on at the 20-week, but we bounced right back. If you go back to 2020 and 2021, same thing. So there's, again, some hope at these rising 20-week EMAs that we're going to bounce off of those and maybe move back up for a couple of weeks. That would kind of follow history, which tends to start to get a little bit more bullish as we move toward the end of July and into the beginning of August. But we've still got the months of August and September ahead of us. They're not the best months for the S&P 500, so we do still need to remain cautious. Now, in addition to all that, I'm seeing some economic signs that are suggesting that we need to be very careful. In my opinion, the Fed has not reacted quick enough to lowering rates. They should have been lowering rates before. What are they going to do next week? Are they going to cut? Are they going to wait for their September meeting? I think they're going to wait, which I think is another big mistake. And so we're seeing the economy kind of teeter here. You're seeing some of the aggressive growth names roll back over and test some kind of critical I wouldn't even say short term, maybe even more intermediate term support levels. And if those go, we could be looking at more selling ahead. So if you go over to our website at EarningsBeats.com, you'll see that we have a link to a free webinar that we're doing this Saturday at 10 a.m. Eastern. I'll be hosting it. I'll be going over a lot of the markers and things that we need to be looking at over the next couple months to determine if this is just a correction in a secular bull market. Maybe it's a little bit deeper. Maybe it's a cyclical bear market. Could it be a secular bear market? I don't know, but we're going to talk about all that on Saturday. If you click the link, it'll talk about the event itself and give you a place to sign up down at the bottom. This is a free event. It's part of a free 30-day trial that you'll get. Also, in this video, in the description, there will be a link to this page where you can come check it out and register. And then also, for those of you maybe that are on mobile devices, we do have a QR code on this slide, which you can use to come right in and register as well. So give you a number of different opportunities to check that out. All right, let's take a look at a few more charts before we wrap up today. First thing, I've mentioned that this is a character change, what we're seeing here in the market. If you take a look at, the last year and a half, and if you take a look at just about any time the stock market is going higher, normally what you're going to see is large cap growth outperforming large cap value. That's what we're seeing with this IWF IWD chart. Since the beginning of 2023, after the cyclical bear market of 2022, growth has been outperforming value. Now, since we began July, there's been rotation, and especially since the June CPI report came out back on, I think it was July 11th or 12th. So, is this just a temporary rotation where we see money rotate into value? Some of the areas like financials and industrials and healthcare and staples and so forth. Is this just short term and then money's going to rotate back to growth? I don't think we have enough information yet. Keep in mind, we just had a huge surge over the last few months in growth stocks relative to value. So right now, I just think we're giving some of that back. I don't think it's anything that suggests this is going to get a lot deeper, at least based on this chart. You can see a trend line that I've drawn off the recent lows. This goes back over a year or about a year. And you can see we have a perfect trend line that's been tested 3 times. We're not even down to that yet. So we may have a little bit more rotation before we get a much, much bigger test forthcoming. But down at the bottom, I show you where the RSI on this ratio tends to be during advances in the stock market and when we need to worry, when we get into that red zone on the RSI. We're not there yet. We're sitting right now, weekly RSI at about 50, maybe just below 48.72. So right now we're still fine. Everything on this chart, it's just a little profit taking in many of the growth areas that went up so fast, and that money is rotating. It's not leaving the market. We're seeing a lot of money rotate into some other areas. So let's take a look at from an industry group perspective. First, semiconductors. Semiconductors, listen, they went from 5,000, the Dow Jones US Semiconductor Index was below 5,000 just under 2 years ago. We got up to 21,000. That's 4 times where we were. If you look at where we were back at October low, October 2023, we've gone from 9,000. We went from 9,000 to 21,000. That's 133% in 8 months, something like that. That's crazy. We shouldn't expect that kind of move to the upside to be sustained. It's all about perspective. So we've got semiconductors pulling back. Good news is, so far, we're holding that 20-week moving average, which we tend to do in uptrends. Again, going back, looking at the chart. So there's been no real significant damage done to this chart yet, even though it feels like probably the bottom's fallen out of semiconductors, but this is where a healthy dose of perspective comes in. Moving on, internet stocks, pretty much same thing, moving up, coming down. We're testing the 20-week moving average. Can we hold? Automobiles not doing as well as those other areas, but we did see a big pop recently because of Tesla making a key technical breakout above about 210. Tesla ran to 265, couldn't get through, has pulled back, and as a result, automobiles have pulled back. Tesla also reported had a chance to maybe make another run at 265. Instead, the stock was down over 10% with earnings. So looking technically at the autos, we've got a recent breakout above the moving averages. I put this green arrow in to mark those moving averages because if we see any additional selling, I'd like to see these moving averages hold. Biotechs, not everything's negative. So yeah, Tesla's down. Google's down after earnings. We're seeing the internet, semiconductors, autos not doing well of late. That's not the case with everything, though. Look at biotechs in the healthcare space, just making a big breakout. I mean, I see a move up, a cup handle, and a breakout, which probably is going to lead to a breakout above the 2021 high, but we need to see that first. Defense, how about this recent top? Steadily moving higher and higher off that 2020 low, and we had a pretty key area of resistance right near 640. And this past week, we've just blown right through it. So again, we're seeing money rotating into some other areas. How about aerospace? Aerospace also making a breakout above recent highs after going sideways for many years. Let's move on to some of the individual stocks. So within the semiconductors, which stock is more important than NVIDIA? So NVIDIA, which had gone over 140, earlier today came down and tested or hit 106.30, which was almost down to that 20-week moving average of 105.57. So this is the key level of support on NVIDIA. As you look back over the last almost 2 years, any kind of a pullback to that 20-week moving average has been your buy point. I wrote an article a month ago about the fact I thought semiconductors had topped and that there was too much risk to be in semiconductors. As we start to see these pullbacks, I think the risk is shifting. It's shifting more on the bearish or short side. And I think as we, meander, down to that 106 level where we are now, or perhaps even lower later this quarter, I would be using this weakness to build positions. Because I think when we get into the fourth quarter, I think you're going to see another push to the upside in many areas of the market, including semiconductors and obviously a leader like NVIDIA. SMCI, notice the low today came right down and tested the low that we saw back in April, at that April low. So don't just assume because we've been weak that we're going to go right below that low. Instead, we went down to 663 earlier today, tested it, and now we're trying to reverse. We're back up at 707. So pretty nice reversal here on SMCI. Tesla, talked about autos. Tesla basically is the autos. And Tesla, after the big move up, has pulled back just like the autos. Looks very similar, the chart. The moving average is what we need to watch for here. Pulling up a daily chart, when we made this break above about 208, I said I thought it would be a quick trip to 265. Well, that's right where we went. We never closed above 265, but we immediately went up and tested it. You can see the high here at 265, another high here at 270. I think that's what we ran into. We've pulled back, but we're still, I think we've got great support with a 50-day coming in at 203. The recent gap support areas, 210 to 220. This area, in my opinion, is an area to accumulate Tesla. Google, as I mentioned, not a great reaction to their earnings. They pulled back, but look at Google testing its 20-week moving average. This stuff is pretty critical. And, chasing stocks, if you get out of the habit of chasing stocks and buying them when they're pulling back to key support levels, I think your trading results probably will go up and improve. How about, so I just showed you some stocks not doing very well of late, but how about some stocks that have been? How about Amgen in that biotech space? Beautiful cup, handle, breakout. This measures to about 380. Excuse me, we're at 339. So I think Amgen looks really good. Bank of New York posted earnings a couple of weeks ago, made a nice breakout on those earnings, and I think is part of that financial space and asset manager that is poised to continue to rotate or to move higher because of the rotation into some of the more value-oriented areas. DR Horton, DHI made a breakout, had a negative divergence, higher prices, lower PPO, but these pink arrows are what I look for after a negative divergence. I look for a PPO reset. At that point, your 12 and 26 week PPOs, or excuse me, your 12, 26 week EMAs are the same. So your momentum is gone at that point. That's why I call this a reset. Also, when you have a negative divergence, I look for a 50 period test, or in this case, a 50 week test. So it was a beautiful retest. And now coming off of that, we're getting a breakout as the market anticipates lower rates ahead. So again, DHI, Amgen, these types of stocks, BK, are stocks that are benefiting from the rotation out of some of those other areas. Anyhow, that's essentially what I have. If you want to follow me, all you have to do is follow your screen here and the slide that's showing. Again, you can use your QR code to go to a landing page that will tell you how you can follow us at EarningsBeats and how you can follow my articles, my YouTube videos, and so forth. All right, so with that, just kind of quickly summarize, I think, the market's in a precarious position right now. I think we're at a spot where maybe we can start to rally and bounce over the next week or two, but you really need to come join me on Saturday because I'm going to go over technical issues that we face. I'm going to go over historical issues the market doesn't like the upcoming months, and the presidential election cycle, which also would favor the bears. And then finally, economic reports. We have markers on economic reports that can tell us, not with certainty, but give us a pretty good idea on whether the market is maybe poised to take a deeper drop. Going to go over all of that on Saturday. I hope to see you there. Happy trading.